Thank you everyone for joining on time. We are expecting a few more participants to join us shortly and will begin the session in a minute. Hello everyone and thank you for joining us for today's webinar. I would request Leevyn to take this further.
Thank you, Gaurav. Good afternoon, everyone, and welcome to today's webinar. I'm Isabel, Commercial Director at Ocorian, based in Dubai, and I'm delighted to have you with us. Today, we'll discuss a topic that's increasingly vital for businesses and families alike, UAE Foundation and the impact of corporate tax. The session is designed to offer clarity regarding the compliance structuring, and I'm especially pleased to be joined by our expert guests from Nexdigm, who brings a wealth of experience when it comes to tax advisory and structuring. So without further ado, please join me in welcoming Nishit Parikh, Senior Director at Nexdigm. Thank you for being here, Nishit. It's a pleasure to have you with us. Would you mind giving a few lines about Nexdigm?
Thank you, Leevyn, for inviting me to this webinar, and it is very important topic and of great relevance in the UAE. So, to introduce Nexdigm is a 6-decade-old firm headquartered in India, and our presence in UAE started in 2017. So we are present in UAE from 2017. We are a professional service firm in the UAE where we do tax, transfer pricing, structuring, M&A tax, entity setup, and various other services in terms of audit, insurance, assurance, valuation, etc. I myself is a senior director looking at tax and transfer pricing and structuring aspects at Nexdigm. Thank you, Leevyn.
Thank you, Nishit. So quick introduction about Ocorian. We are what we call a fund, private client, corporate administrator. So essentially, we could set up any form of legal structure, whether it's a fund, capital market, corporate, or private client structures out of 20 plus jurisdiction. We've been in the UAE for the last 15 years, based in the DFC and ADGM. I think let's start first by explaining exactly one of the main topic here is the UAE Foundation. Just to give you some background about the structure itself, what's a foundation? It's a separate legal entity. So essentially in UAE, you have three regime of foundation: DFC, ADGM, and RAK ICC. DFC and ADGM are what we call federal financial free zones. So those structures, those foundations structured there are licensed and incorporated in these jurisdictions. They're managed by a group of officers, what we call council members. They are essentially directors. Think of them as directors. They have the same fiduciary duties of directors. And an important point that Nishit will raise later on is where those directors are based is basically where the place of effective control and management, and that will impact the taxation of the foundation also. The foundation legally owns the assets, and there's no shareholder. So essentially, those are corporate structures without shareholder. And the objective of private family foundation is essentially to hold the asset for the benefit of beneficiaries, most of the time family members. These are the 5 basic characteristics of any foundation around the world. But most of the questions that people ask us is, how does it differ with trust? And it's essential to have this comparison because the law of corporate tax refers also to the trust regime. So a foundation is a civil law equivalent of a trust. 2 main differences, if you might remember that, is essentially a foundation is a corporate vehicle compared to a legal arrangement as trust, and there's no trusting owning your asset. So under a foundation, the foundation itself owns the asset, and the foundation is managed a little bit like a company with a board of council members. So those are basically the two main. There are a couple of different differences between those two structures, but the main differences are one is a corporate vehicle, one is a legal arrangement, and one is controlled by the council, while the one is controlled by the trustee. I will leave that, but the slide will be shared with you. Nishit, if you have any question on that, but I think you should move on now to the corporate tax part. Yeah.
Sure, thank you. We all know that in UAE, corporate tax is now live. First tax filing season is soon approaching. So for the year ending 2024, the tax returns are due in September for companies having financial year as calendar year as their financial year. And recently, UAE has come out with a guide on family foundation, and also they have come out with a specific decision on compliance requirement for a family foundation. So the guide provides a lot of clarity on family foundation. One of the important aspect which the guide talks about is that family foundation can be any vehicle which is used to invest and manage investment for family. Typically, the terminology used is family foundations, and they have went ahead and also described various possible structures which can be considered as family foundation under the UAE corporate tax law. So they say that any entity which is set up as a foundation under the specified laws and regulations which are there in the UAE, like your DIFC Foundation, your ADGM Foundation, or your RAC ICC Foundation. They've also said that if you have set up incorporated trust, then those also can be treated as family foundations, and all the taxation related rules and regulation would apply to them as well. Similarly, they have said that this restriction is not only, or this treatment is not only for family foundations within the UAE, but even if you have a family foundations outside of the UAE, and a lot of other countries, GCC countries and other countries also have structures which are similar to family foundations or which are in the nature of foundation, those also can be considered as family foundations for the purpose of UAE corporate tax. And other than that, any entities which is of similar types where the main objective is to manage wealth for families and for the beneficiaries would also be considered as family foundation. Leevyn, any questions?
Yes. But it will be interesting to know, but we have it on the slide later on. But under what condition would a foreign foundation typically have to register? I don't know whether you want to tackle this now or later on. Yeah.
So foreign, I can take it up right now. Foreign foundations having either assets in the UAE in terms of real estate, assets, investments, etc. So for example, if a foreign foundation is having a real estate in the UAE, that potentially could create a nexus for the foreign foundation in the UAE. And as per the nexus rules in the UAE, the foreign foundation would be required to register and pay taxes on that income which it derives from the real estate. However, if it satisfies the condition which we will discuss in the later slide to be treated as a fiscally transparent or as a pass-through entity, then that foreign foundation can be treated as a pass-through, and the income which it earns from the real estate will go in the hands of individual, and those individual would not be taxed on real estate income because individuals are specifically exempted from paying tax on any real estate income or any investment income which they can own without having a requirement of getting a license from any of the UAE authorities.
Thank you, Nishit. Just one point, it's interesting to see that the authorities already anticipated the rise of trust. Essentially, we have free trust regime in UAE, ADGM, DIFC, but we also have a federal trust regime. And this very, very interesting that the FTA and the minister already have this plan but these regimes could also benefit from the same family foundation classification. Will you be able to tell us a little bit more about the classification? Yeah.
So again, what they are essentially looking at is that what is a structure? If the structure is similar to a structure which has a central body controlling the investments, and the objective is to manage investments and generate wealth for a particular family or particularly identified class of beneficiaries, then that structure, in whatever form it is, be it trust, foundation, or any other form which is relevant in other jurisdiction, would be classified as a foundation for UAE corporate tax law perspective, and subject to meeting conditions which we will discuss, would be eligible to be treated as a pass-through vehicle.
Correct.
Now coming to the taxation for family foundation, couple of important clarification which has come about in this guide is that while the interpretation and the position, previous slide, sorry, the position remained always the same, that foundation should be treated as a juridical person, but now they have clarified clearly. So what happens when foundation is treated as a juridical person? It becomes liable to tax in its independent capacity. Also, the moment we say that when a foundation is a juridical person and it has subsidiaries or companies under it, then potentially you can also explore forming a tax group, because tax groups require two resident person who are juridical person. The shareholding condition is relevant only for the subsidiaries. So holding company can still be a foundation, and it can form a tax group if you are paying tax at a foundation level and you want to minimize the compliances. Second point which they have highlighted in the guide is that free zone, if it is set up in a particular free zone, in line with the regulations of those free zone, would be considered as the person registered in that particular free zone, and hence automatically it will become eligible to claim the benefits of the free zone related benefits, which we will discuss in the subsequent slide. Again, third and important point, at a foundation level, if you decide not to treat it as transparent, then you will be liable to tax, and as we all know, tax is on profits of the foundation after deducting all the expenditure which it incurs to earn that income. So effectively, you end 1,000 dirhams. So this is important because what may happen that in initial years where you are having holding companies or investments, and if you are not looking at generating income immediately for the foundation, then you should actually evaluate whether you want to declare the foundation as a pass-through, because the moment you want to declare it as a pass-through, the FTA has all the rights to ask the details of the beneficiaries, your charter documents, etc. So again, if the purpose of the foundation was to have flexibility in changing the beneficiaries or in keeping the secrecy of the beneficiary, then you may want to really evaluate whether you want to utilize the benefit of it being fiscally transparent. And one of the key consideration of deciding that would also determine whether, as on today, even if your foundation is paying tax, whether actually there is taxable income or not. Obviously, the
Correct.
moment you decide to pay tax at a foundation level, you would be required to take a registration, you would be required to file a tax return for the foundation. And like I mentioned, foundations can be treated as pass-through subject to meeting four key conditions, which are there in the next slide. Sorry, Leevyn, you were asking me something.
Yeah, so just to take a step back, Nishit, here. Foundations are judicial person, so liable for corporate tax. Currently, the corporate tax is 9% above any taxable income above 375,000 dirham, which is about 100,000 USD. That's the default position right now. And then based on that, if I summarize correctly, you have a type of income that can determine whether you're paying tax or not. And you have a type of positioning in terms of type of structure, whether you want it to be passed through or not, that might give you some benefit. So when you tell us that a foundation is passed through, so essentially there's no tax liability at the level of a foundation. That's right?
Correct.
Okay. No. Fact,
So
that's
in
clear.
fact, what I was alluding to that if at foundation level only, if you are not eligible to pay tax, then whether you want to go and treat your foundation as pass through for other non-tax reasons, like I mentioned in terms of not disclosing the identity of your beneficiaries or not being made to submit your charter documents to any authorities. So
Perfect.
in next slide, I have discussed one of the important aspect on free zone benefit. So as we all know that free zone companies or free zone juridical person are eligible to claim benefit of 0% corporate tax rate if they meet specified conditions uh, under the UAE city law, and the conditions being having substance within the free zone, being not suo moto electing to be treated as a taxable person under the normal city regime, complying with transfer pricing regulation in case you have any related party transactions or any payment to connected persons, that is your C-suite people or shareholders. And most important condition is deriving qualifying income and getting your books of accounts audited and not breaching the de minimis conditions, that is not earning any non-qualifying income in excess of 5% or 5 million dirhams, whichever is lower. So typically in a foundation structure, which one of the objective for which the foundation is set up is to make investments. So today if you have set up your foundation only for holding investments in your operating companies in different jurisdictions or including in the UAE, then potentially you can explore, if you are able to satisfy all of these conditions, then at a foundation level, you may be eligible to claim the 0% corporate tax rate, and foundation will have to file the tax return stating that they are eligible to 0% corporate tax rate. So there may not be any requirement for you to actually use the pass through related mechanism, and at a foundation level only you don't end up paying tax.
Right.
Obviously on the substance side, your
That was my next question, yes. So
members or the
what
governing
does this
council.
mean for foundation? Because right now, the majority of foundation has registered agent providing the address. What does this mean maintaining adequate substance for a foundation?
So typically substance would entail having educate number of people, educate number of expenditure, ensuring that the core income generating activity is happening from the free zone. However, there is a specific exemption from having employees for holding companies. And if we equate foundation similar to a holding company, then it should be, in my view, enough if it can be proved that the council members of the foundations have taken the decision for making the investments or are involved in whatever new decision the foundation makes to ensure that the substance test is met.
Right.
Again, from a qualifying income perspective, there could be multiple or at least couple of line items which we can look at. One is main is the holding of shares, where
All right.
typically you have conditions of holding the investment for more than 1 year, and that in a way would help you get the benefit of the free zone tax regime.
Correct. Just one fun thing maybe for our audience to know, a foundation is not allowed to provide any form of business activity. So the activity of a foundation is typically holding per se. So there is very few scenarios where we can see the qualifying income not falling within this category. It should be holding typically. So you're telling us if my foundation holds businesses, for example, and of course, you will talk about the two additional conditions when it comes to de minimis minimum, but investment into businesses where there's no active trading of those assets or investment would basically be falls under the definition of qualifying income.
Yes.
Okay. Can you tell us a little bit more about the de minimis condition, please?
So today, de minimis condition is that in case the foundation, in addition to the qualifying income, is earning non-qualifying income. So one potential non-qualifying income could be that you've had a investment which you hived off for a period or held that investment for less than 1 year period. Then technically the holding of shares condition is not met, and that may become non-qualifying income. So if that income is less than 5% or 5 million dirhams, whichever is lower, then you can continue to claim the benefit. But in any case, if that income exceeds 5% of your total income or 5 million dirhams, then you may lose out on the benefit not for that year, but additionally for 4 years. Or in addition to that, you may have any other income which is a side activity and not necessarily the main activity. And that results in breaching of the de minimis condition. Then again, you may not be able to have the benefit of the free zone.
All right. So just to recap, if I have UAE real estate, I have any other income that doesn't fall within the category classification of qualifying income, or if I don't satisfy the minimum de minimis, basically, I will not be able to qualify on the qualifying free zone person benefit. Okay. Okay. I'm conscious of time, so I'm just going to move on to the next exemption.
Another exemption which foundation can explore is participation exemption. So currently in UAE, as we all know, any local dividend, that is any dividend or capital gains received from a domestic company, that is a UAE resident company, is exempt any which ways. Further, in case of investment made in companies which are outside of the UAE, that is in a foreign jurisdiction, there also capital gains and dividend income can be tax free if you meet the participation exemption conditions. Some of the key conditions on participation exemption is that the holding in that foreign entity should be more than 5%, and you should be eligible to receive the profits on liquidation of that company. If you are not meeting that 5% test, then there is a minimum investment test. So you may have a 4% holding, but if that holding value is more than 4 million, the cost of the investment is more than 4 million dirhams, then still you can avail the participation exemption. Second condition, similar to the holding of shares condition, that the interest or the shares should be held for more than 12 months, or the intention should be to hold it for more than 12 months. And third and the most important condition is that the country in which you are holding the investment, say you have one company in BVI, one company in Egypt, then for the BVI company, there could be potential issues because the law requires that the country in which you are holding the investment, the baseline corporate tax rate of that country is more than 9%. Whereas for the Egypt entity, you may satisfy, but for the BVI entity, you may not satisfy, and hence participation exemption may not be available. Again, they also have an anti-avoidance condition that just by interposing a holding company in a taxable jurisdiction, if you are not meeting the condition, so for example, if you have a company foundation in UAE, and below UAE you have set up a holding company in Mauritius, and through that you are holding 1% stake in a company in, say, India, 20% stake in a Cayman company, then while at a Mauritius level you are satisfying the condition of 5% corporate tax rate being more than 9% at a Mauritius corporate tax level, while dividend may not be taxable, but at a corporate tax level 9% tax is more than 9% tax is there in Mauritius. But below that you are not satisfying the condition, because in India you are only holding 2%, and in Cayman you are holding 20%, but there is no tax in Cayman. So they will say that they will also look at your step down subsidiaries to see whether they are meeting the condition, and at least 50% of your step down subsidiaries should meet the condition in order for you to claim the benefit.
Understanding. Okay, that's super clear.
So, Leevyn, any questions, or we can move forward?
No, that's super clear. So there's an assessment that needs to be done for each investment technically held by the foundation to determine what type of exemption. So just one thing on the participation exemption, it's possible to avail for any given period, and then if you don't fall within those category conditions, then for a given year you might not avail of this participation exemption, right? Okay. Okay, so those are the conditions. Yeah.
Yeah. Okay.
I think you've covered most of them. Again, what does constitute adequate substance and what does constitute qualifying income
No,
for
I
this
think so.
case?
This is the slide which is repeating. I think so.
Yeah.
You need to move
Okay.
forward.
I think
Yeah.
we've done those two. Now the main exemption that's allocated to family foundation is the pass-through.
Yeah.
Yeah.
So
So
now
it's
the most important part, which everybody I think so is looking to hear and understand. The UAE Corporate Tax Law provides for a specific provision under Article 17 to say that in what scenarios a foundation can be treated as a pass-through. So they have given four key conditions which the foundation needs to satisfy in order to uh, claim the benefit of it being fiscally transparent. First condition is that it should be established for benefit of identified or identifiable natural person or a public benefit entity or both. Why I say identified or identifiable is important because they are okay if you identify some of the beneficiaries right now and then say that, say for example, Nishit is the beneficiary and future children of Nishit would also be the beneficiary. So they have given you a leeway that you can have future beneficiaries which can be identifiable as of now. But it cannot be that Nishit is the beneficiary and he can decide after 2 years what could be the additional beneficiary. Then it comes under the gray area whether those can be considered as identified or identifiable beneficiaries. So for foundations where you have not defined any identifiable or identified beneficiary, they may not be able to meet this condition. And the moment they are not able to meet this condition, they may not be able to get the benefit of the pass-through status.
yeah. So
Second, yeah,
I just want to add a point on that before we move forward on the conditions. So a foundation can have three types of beneficiaries, essentially. You can have a fixed interest beneficiary, basically paying a specific amount on a given timing. You can have prospective beneficiary upon the death or something happening. And you can have also what you call discretionary beneficiary. And essentially what we've done for these cases is to have at least one main beneficiary. But ideally UAE resident, but doesn't really matter, but one main for the purpose of the filing purposes. Yeah. So that's it. Yeah, you should.
yeah. Second condition is like I think so. Leevyn also highlighted that foundation cannot conduct any business or business activity. Business and business activities are defined broadly to say that any activity which is done on a continuous basis or which requires a license to perform those activity. Merely because foundation is registered in DIFC and obtains a license from the DIFC authority would not result in violation of this condition. Third condition is that principal activity of this foundation should be to hold investment or manage investments for a particular set of beneficiaries. And last but not the least, that main or principal purpose should not be to avoid uh, any tax. Merely applying for pass-through status, which results in non-taxation because the beneficiaries are not liable to tax, would not result in this condition being kind of violated in terms of avoiding tax. That is what has also been clarified by the law. Other important aspects which came out of the guide and the decision, that pass-through status is also available to the subsidiaries or fully owned and controlled directly or indirectly by the family foundations. So one of the larger problem which the industry was facing was that foundations were created below those foundations there were holding companies to hold real estate, there were holding companies to hold investments. And when this entire law came in, real estate holding entities were liable to tax and there was no exemption, even if they were in a free zone, unless they hold a very specific asset in the free zone. That created a challenge, and now to solve that problem, the pass through status comes to help because now the real estate company as well as the investment company can be treated as pass through. Their income and expense goes to the foundation, and then from foundation it goes to the individual. The important thing is everybody in the chain has to be found to be treated as pass through in order to get the benefit. Obviously, in addition to these two companies, if you have a business company, that business company cannot be treated as a pass-through because, like we said, that one of the condition which is there is it does not conduct any activity that may constitute business. Again,
So,
the timeline provided in the law for registration of foundation to be treated as pass-through was to be made before the end of the relevant financial year. That is for 2024, it was December 2024. However, the recent decision and guide has now appreciated the fact that lot of taxpayers were not aware of this timeline, and also there was certain lag in terms of enabling
mortality.
the portal for making those application, and hence now they have extended the timeline to 2025 for making application even for 2024 or the prior year. So there is a one-time window available up to December 2025 to make application for 2024 also. But going forward, you need to ensure that if you are making an application in future for a new foundation or for foundation which was not earlier treated as pass-through, you need to make it within the year.
Super.
Third and most
Okay.
important aspect which is there is that the moment you treat anything as pass through, what happens to the balance sheet? How does the P&L look of that particular entity? And how does the income allocation happen? So the family foundation uh, guide highlights that the moment you treat anything as pass through, all the income, expenditure, assets, and liability would be treated as it is of the beneficiary, and appropriate if you are having a step down subsidiary, that step down subsidiaries asset, liability, income and expense will go to the foundation, and then foundation will go to the beneficiary. So they say that adequate details would have to be provided by the respective entities to the beneficiary in order to examine whether they are liable to tax, and they would be also eligible to claim the expenditure which have been incurred. So to give you an example, say for a family foundation which is holding multiple real estate, and in addition to the real estate they are also running a motel. So if that motel was run by a particular individual, that would have required a license, and that would have been considered as a taxable business activity. So now the foundation will have to provide the income details, expenditure detail of that motel business to the beneficiary in their respective shares, so that they can compute and evaluate whether they are crossing 1 million dirhams, which is the limit for an individual to register when it is doing a business activity, and then pay the tax on that particular income.
Perfect. Okay.
Fourth point
Great.
is probably what we discussed. Foreign foundation having nexus are required to apply, but they can kind of avoid that taxation if they treat themselves as fiscally transparent and the income goes uh, to the beneficiaries. Fifth condition is that additional responsibility has been put on the foundations, saying that in each year, after the end of each year, within 9 months from the end of that year, you need to intimate to the authorities. Again, the format would be prescribed. It is not out yet. At least I have not seen that. That all the conditions which we promised in year one are continuing to be met in year two, three, four, five, till the time you are in existence. Again, given that these clarifications are coming right now, the deadline has been extended for any tax period which ended before 31st March 2025. So if your tax year ended on December 24 or March 2025, you have time up till 31st December 2025 to file that declaration.
All right. All right.
Divine, any
So,
questions or we can move forward?
yep. So, just to touch base on in terms of compliance, so the whole idea here, understand that we're shifting, there is no tax to be paid by the foundation and any form of income underlying, but transparent. In terms of compliance, then, if I don't have tax return to do, there's less work. We just need to do that filing once a year, stating who are the beneficiaries and what allocation. So essentially, apart from the benefit of not paying that corporate tax, is also reducing that paperwork and in terms of compliance. So
Correct.
if it
And
is
according to
really
me,
public foundation, it should be quite straightforward to do that filing. Yeah.
correct. And according to me, that filing also should be pretty straightforward. You may have to tick on all the condition and say, yes, I satisfy the conditions. That's how it should be.
Yeah. So thank you, Nishit. I don't know if there's any questions here, but just to recap, I don't know whether you want to talk about that.
Yeah, so just this is a summary that if on the left hand side we have highlighted that if you treat foundation as a juridical person and not treated as pass through, subject to you may have to pay tax at 9% on income in excess of 375. Foundation would then be obliged to file a tax return, but here you don't have to go to FTA for anything. Second option is you treat it as pass through, then the foundation just have to register and make an application for being treated as a pass through with the FTA. But then you don't pay any tax unless the individual has a specific scenario of earning any business income and it is above 1 million, then the individual pays tax. And lastly, at a foundation level also, you may not end up paying tax if you are meeting the test of qualifying free zone person or the participation exemption.
Perfect. And apart from that, we also have a nature of income. So to recap, income from UAE companies, be it dividend or capital gain, are exempted. And you also have a participation exemption that the foundation can
Right.
avail. So thank you very much for that, Nishit. So let's move now to the structuring part, if I may. So that's a typical structure of a family foundation where an individual will basically set up a foundation, appoint and nominate, appoint the council members, the beneficiaries, and transfer the asset. So we keep it very simple here, Nishit. UAE foundation, UAE business, UAE real estate, and liquidity could be international. Tell us now what are the different options that foundation can avail of.
So here, if you look at this typical structure, on the left hand side where you are saying there are UAE businesses. So like we discussed earlier, a foundation, the business would not be eligible for the pass-through benefit and foundation itself cannot do a business. So ideally, in a very ideal scenario, it should be done through a corporate structure in between where the business can be housed. But assuming this scenario is possible, then for this UAE businesses, you will pay 9% corporate tax, or you may claim the free zone tax benefit if the business is
Correct.
in the free zone and eligible to be claiming that benefit. And then whatever residual profit is there, that may get declared to foundation as dividend, or it will come to the foundation as dividend, and that may not be taxed because it is dividend received from the local company. So in this case, probably it is pretty clear, and foundation may not be required to opt for fiscally transparent status for this particular step down entity. However, now
And
coming
what
to
about
liquidity and UAE real estate, from a UAE real estate perspective, like I mentioned, if real estate is done through a company, that real estate income or done through a foundation would be liable to tax in the hands of that company or in the hands of the foundation. So you're subject to meeting all the four conditions which we discussed in the earlier slide. The UAE foundation can decide to be treated as a fiscally transparent entity, and the real estate income which the UAE real estate company is earning will go to the beneficiaries, and beneficiary will not pay any taxes because any real estate activity done by the beneficiary which does not require license would not be liable to tax in the hands of the beneficiary. Similarly, liquidity would typically mean short term or medium term investments which the foundation would be making or the entity which is created would be making. Again, this potentially from a foundation perspective, you need to evaluate whether it fits under the qualifying free zone uh, benefit or not. If not, then it may become liable to tax in the hands of foundation. So here again, the foundation may use the fiscally transparent status to take it to the hands of the beneficiary, where any investment income of the individual is not liable to tax.
So it seems that Nishit, the transparency option in terms of a pass-through is the ultimate solution, basically, because no matter what the nature of the income, if you tick the box as a family foundation, there is no tax typically, no matter what type
Yes.
of income that you're receiving. Okay, that's great. So let's make
Only,
it a little
only
bit more.
one particular caution here, Leevyn. If these beneficiaries are not residents of UAE, or there is a combination of residents of UAE, resident of UAE, as well as resident of other countries, then potentially the moment you do a pass through, we need to examine the laws of that respective country as to how those tax laws of those country would treat this deemed pass through status. Because even if you don't make an actual distribution and you make a book entry, whether that country law would consider it as an income which is accrued even though not received, and make it liable to tax in that country. And if that country happens to be somewhere in Europe where the tax rate could be 40% and upwards, then the entire uh, tax efficiency may go for a toss. In those cases, it may be better to pay tax at a foundation level and be happy with the 9% which you are paying.
Okay, yeah, that's clear. So let's make this structure a little bit more complicated now. Let's suppose each of these type of asset are held by different UAE holding company, and for the purpose of this discussion, those are free zone holding companies.
So again,
Would you,
similarly, this UAE holding company would have to, in their independent capacity, evaluate whether they are eligible to free zone tax benefits. Assuming UAE holding company 1 is eligible to claim the free zone tax benefit, then again, there is no requirement for treating it as pass through. But like you mentioned, if in both the scenarios you are not paying tax, then you may want to treat it as pass through and not do compliances.
perfect. Okay, makes sense. And same thing, I guess, for UAE real estate, the only solution is the pass-through at both levels, the foundation and the holding company too.
Correct, because UAE real estate, unless you are holding a real estate in the free zone and it is a commercial property, you may not end up getting the benefit of the free zone. Then it may be advisable to treat it as pass through so that you don't end up paying tax. And for liquidity, again, you need to examine whether you are eligible to that benefit or
That's
not.
good. Okay. So it's essentially, if the foundation fully own and control those holding company also can be treated as pass-through.
Yes.
Okay. So thanks for that.
So
Let me just,
the law says that foundation and any of its uninterrupted chain of entities. So even if say under holding company 2, you have 10 more companies and all are within an uninterrupted chain and they are meeting all the conditions of not conducting any business activity, nor no tax avoidance, set up for the purpose of investment, etc., then all 10 can be treated as pass through.
superb, superb. Okay. So thanks, Nishit. Let's now move to another scenario where the UAE Foundation holds holding company outside of UAE. Let's assume Cayman or BVI with asset and real estate and liquidity outside of UAE. So essentially, that's a UAE Foundation that's holding international asset. What are the options for each of these right now?
So if these holding companies are outside of UAE, first test again would go back to the same analogy, whether you're holding the investment for more than 1 year and you are able to claim the benefit of free zone, then there would be a zero tax.
Oh,
Second
no, no.
option
The holding
typically,
company is in Cayman. Do you still apply for the free zone exemption there? No.
yes, we will still apply for free zone exemption because free zone exemption talks about holding of shares anywhere. Only
Okay.
condition is that you need to hold it for more than 12 months. If that fails, then you go to the second test of participation exemption. There again, potentially it will fail because the example you gave is BVI Cayman where there is no 9% tax. So you end up then kind of not getting both the benefits. Now, given the fact that these holding companies are outside of the UAE, the holding companies may not end up paying taxes in the UAE unless they are considered as having POEM within the UAE. So
With a
if there
direct,
is no
a
POEM within the
director.
UAE, the BVI company, Cayman company on standalone basis would not be liable to tax in the UAE. But whatever dividend it distributes to the UAE Foundation, and assuming UAE Foundation is not meeting the participation exemption test and the holding of shares test, then that dividend can become taxable in the hands of the UAE Foundation. So in order to avoid that, again the foundation can consider itself as a pass through and divide its income between the beneficiaries so that the dividend which is earned by the beneficiaries from the holding companies directly would not get taxed because there you don't have to look at any condition of 5%, 1 year holding or 9%, etc., etc.
Oh, that's interesting. And I guess the same assessment will be done for the real estate and the liquidity then.
Yes, same assessment, same assessment.
Just one point when it comes to the beneficiaries. So what we've seen is for DFC Foundation, for example, it is possible to have what we call a contribution agreement. So essentially, beneficiaries could say anything that's paid to me in a given year, I've already agreed that it's contributed back to the foundation. And what you really want to do is on the same day that a distribution happening, that contribution happens. And I heard you saying it's a book entry, but essentially because the waiver law is drafted, you need to make that distribution. So basically, there is an amount payable to Nishit, and that amount straight away on the same day goes into a contribution. And by doing a contribution, it's out of your patrimony or your estate. So yes, you will have that window of where you had an income accrued to you, but that window can close rapidly if you have a contract that's already in place. So there are different
Right,
mechanisms there just to safeguard this type, especially if the family don't plan to have distribution per se. And
correct.
the sole idea of the sole purpose of doing all this distribution is because the way the tax law has been drafted. Yeah.
Right. And one more important aspect which I wanted to highlight on this is that we've seen many structures currently where individuals in UAE for some reason have created holding companies in Cayman BVI and which are then doing investment activities in various global markets. So currently, as we discuss with those clients, we understand that those structures are becoming taxable in the UAE because the guy sitting in the UAE and controlling the investment sitting in the UAE for the BVI or the Cayman entity, and that entity is becoming to have a poem in the UAE and hence becoming liable to tax in the UAE. So obviously, while UAE has the GAR provisions, which talks about tax avoidance, but typically for those kind of structures, if those structures are now parked into a foundation, so if that individual creates a foundation and that shares of that company are settled in the foundation, and then that company is treated as a pass through after it becoming a poem entity in the UAE, then the entire tax can be saved. But obviously, this is not an advice. You need to look at the facts, circumstances, and everything because there are overarching GAR principles also in the UAE.
Okay. Wow, that makes sense. Thanks, Nishit. Let's go through some structures that you suggested just to show exactly. Yes. So tell
Right.
us here.
So there are certain, yeah, sorry. There are
No, tell
certain
us.
specific nuances of foundation and treating step down subsidiaries as pass through entities, which the law provides. So, law talks about a key term that foundation and its multi-tier structure, which is wholly owned and controlled by the foundation, would be treated, would be eligible to be treated as pass-through entities. So in this structure where say foundation is holding two companies, that is holding company for making investments and a real estate holding company. However, in the real estate holding company, the beneficiaries are holding 20% shares directly in the same proportion in which they are eligible to receive shares from the foundation. So effectively, there is no difference if they would have held this through a foundation or some portion directly. But that is how, if the structure is, then the real estate holding company would not be eligible to be
For the
treated as
pass.
pass through because it is not completely controlled and owned by the foundation. Whereas holding company for investment, which is 100% owned by the foundation, that may still be eligible to be treated as a pass through entity.
Okay. Okay, that's clear. So let's go for this one now.
Again, here, if you look at same beneficiaries have for some reason created two foundations and they are holding real estate A, where there is a joint holding by Foundation A and Foundation B, and real estate B is 100% owned by Foundation B. So here also real estate A holdco will not be eligible to be treated as pass through because it is not held or controlled completely by a particular
Right.
foundation, even though the beneficiaries are same.
Wow. Okay. So we need to have this 100% control and ownership by one foundation for the underlying vehicle to benefit from the pass-through.
Correct.
Yeah.
So
And what about this one?
in this structure, both real estate A and real estate B holdco can be can opt for pass-through status because foundation is controlling real estate A company 80% directly and 20% indirectly through the company X, which is the holdco which it has set up. Same way, real estate B company also can be treated as pass-through because it is controlled by the foundation 100% through company X. But it is important that company X is also treated as a pass-through. It cannot be that you treat company B as the pass through and you can't treat company X because the investment in the income for A and B will come through company X.
Okay. Okay. Thanks very much, Nishit. I think we believe we've reached almost and part of a Q&A session. Nishit, thank you very much for your time. Would you like to take some of those questions? Yeah.
Sure, we can. There are few questions which are there in the chat box. Okay, first one is probably for you, Leevyn. It says, can the beneficiary also be the council member?
Definitely, definitely. So anyone essentially can be a council member. Of course, you will want that council to be UAE based, UAE resident, essentially, to avoid having any form of claim that person is sitting outside of UAE. I think the second one would be yours. If a foundation
Yeah, if
forms
a
a tax,
foundation forms a, yeah.
should consolidated financial be prepared at foundation level and submitted to FT?
Ideally, the answer should be yes, because that's how the foundation and the tax group structure works, where the parent company has to do everything. So
For those non-tax people there, a tax group is basically you do only one filing for all entities. Is that correct, Nishit?
yes,
On
yes,
tax filing, so it minimizes the paperwork and the amount of filing. You do only one filing for any entities held by that. So that's the benefit of having a tax group. Yeah.
right. So again, third
So,
question is any limit on transaction amount for complying with arm's length price for the related party transaction? So the UAE tax law provides that any related party transaction should be at an arm's length price. So there is no uh, specific monetary limit in terms of which transaction needs to be at an arm's length. However, there are monetary limits provided in terms of reporting. So in case for reporting in a transfer pricing disclosure form, there are primary and secondary limit where overall related party transaction should be more than 40 million dirhams, and each category of transaction should be more than 4 million dirhams. Then you need to report in the transfer pricing disclosure form. Second, there are specific limits for maintaining uh, local file, which is 200 million dirhams of turnover by the UAE entity, or UAE entity being a constituent entity of an M&E group where Pillar 2 provisions are applicable.
so just to be clear, this is only applicable for qualifying free zone um, exemption, right?
So transfer pricing is one of the condition which is applicable for any transaction you do in UAE with related party, but it is one of the specific condition in the free zone law as well.
Perfect. Okay. More questions for you here. We have 6 minutes left. So if a foundation does not elect to be qualifying free zone in the first year, can it make this election in the next 2 or 3 years when it's active?
So what you need to do in this case, and the law specifically provides that in initial year, when a particular entity in free zone does not have any income, they can still go ahead and apply for the benefit of the free zone. So you select in the year one itself that I am eligible, even though the revenue is zero, so that you continue to remain eligible for next 5 years. And in second year, again, you examine. In case you are not meeting the condition, in the second year, you say no, rather than saying no in the first year, because the moment you say no in the first year itself, then you may end
Oh,
up losing out the benefit for the 5 years itself.
okay. So next question for you. The condition for the participation exemption, is it tax rate or effective tax rate? higher than 9%?
It it talks about headline corporate tax rate. So it may be possible that the participating entity may not be paying taxes, but the headline corporate tax rate of that country is more than 9%, then 9 or more, then you may
The
still
question
be
comes from
eligible to
Mauritius because
claim the
we have
benefit.
a tax rate of 15% there and potentially paying only 3% for certain type of.
Correct.
Oh, thank you very much. And well, I mean, we have a couple more. Let's take that. Application to pass through has lapsed in December 2024. Does this mean the foundation can apply now? I think we've answered that.
Yeah,
Yes, you
now
can apply.
31st December 2025 is the extended timeline provided for people who have missed.
Okay, that's another very interesting question. Can a pass-through foundation avail of DTA benefits? So for those non-tax people, UAE has a number of double taxation treaties with, I think, about 120 countries that basically provide for tax benefit if suffered abroad. So, Nishit,
So here again, see, when you say the foundation is passed through, the entire income and expenditure of the the foundation would become income and expenditure of the individual who is holding that income. So typically, tax treaty benefit, you will have to look at the language of the tax treaty, because in context of many European countries, there is a concept where the partnerships or the LLCs are treated as pass-through in those countries. And there are specific treaties which UK has entered with various countries where they have said that the tax treaty benefit can be availed if the entity is passed through and the beneficiaries of that particular pass-through entities are resident of that country and paying tax in that country. So again, it's not an easy answer, but you need to look at treaty by treaty to actually answer that question, and look at the facts of each case. Then we will be able to kind
okay.
of answer.
Essentially, we will never use a foundation to apply for a tax resident certificate to avail for the DTA benefit. We'll use that for a company where we can do those conditions and satisfy that in a much easier way than putting the foundation upfront for investment. Then also, can a foundation obtain financing through a loan and investor proceed to generate investment income without jeopardizing the tax exempt status? If it's not a business activity, I suppose it should be okay to do that. What about the tax exempt status?
So, so the moment you obtain a loan for financing your activity, if the foundation law allows you to take a loan to do investment activity, I don't foresee a challenge in terms of it violating any of the conditions which are there.
Okay, thanks. We've left with 2 minutes. I don't know whether we've got so many questions coming in. Do you want to take some more? Or?
So we can take last couple of questions, and one question is for you. Can a foundation have more than one guardian at any one time?
Yes, you can. It's tricky. You will need to draft your bylaws accordingly to avoid situation of deadlock, basically conflict between the guardian. But yes, the law doesn't mention specifically one guardian. Yeah.
Yeah. And last, can this structure for global assets apart from UAE asset? Okay, the question is not
Can
so
be
clear.
structured. Yes, definitely. Of course, subject to
Okay.
tax advice and subject to the law of the land where you're holding that asset. Yes, definitely.
Okay.
One last road, can a guardian be held personally liable for any failure of a foundation to comply with any tax-related obligation? That's interesting. Council members are, and depending on the powers, are basically directors of companies of financial fiduciary duties towards the foundation. So they could be held responsible, yes, for failure to operate. Yeah. I think that's all. With some other questions, we will answer directly to those people. Nishit, I would like to thank you very much for your time and thank everyone else. Would you like to do closing remarks? Yeah.
Sure. Thank you everyone for attending this webinar, and given the fact that the matter is evolving, and if you have any other questions or you need to have any discussion with either me or Leevyn, our details are there on the slide. We would be happy to connect with you and see how we can help you. Thank you everyone.
Thank you. Yep.